So in VMW, what we're trying to accomplish here is we want to get long because we think the stock is going to make a move up gradually over the next 15, 20 days. So what we're trying to accomplish is a way to get bullish. A way to get bullish without spending a lot of money and giving us a little bit of protection in case our prognostication is not correct in the direction that we're predicting here. So what we're doing is we're going to just buy the time spread. And that time spread is going to give us 17 deltas long, as we talked, with the stock as we're looking at roughly 84.35. So we're still almost $6 out of the money. But with a rise and the stock going up, chances are what will happen, as is by my description of when the time spread has its biggest value, greatest value, is that time spread will expand. Well, what we want to look at to verify that is let's look right now at the 85 time spread. Okay, here's the 85 in October. It's 410, 430 call, 170, 175. So when you look at the market on this spread, it's basically 260 is the offer, and the bid is 235. So it's 235, 260, as you can see right here. So when you're looking at a time spread, which is basically the same 2 months that we're looking at, and you're looking at it very close to that, what I consider the greatest valuation, near the price of the strike, you see that it's trading around 235, 260. But as we know, as time dissipates and these 8 days that are left here start to evaporate, we know what's going to happen to the 85 call, which is right here at 170.75 in September. It's going to slowly evaporate with those 8 days by the volatility premium coming out of it. So as that happens, what's going to happen is that the value of the spread is going to go from 245 theoretical value, the midpoint roughly, probably to about $3.50 to $4, because that premium in the 85 call in September is going to totally evaporate, and you're probably going to hold most of this value of the October call. So when you think about us hoping for the stock to go to the 90 strike, you can see right by the difference of the 85 strike to the 90 strike that there's a difference in the pricing, because obviously in order for the spread to expand, we got to get near the strike. So we're going to buy this 90 time spread, buying the OCK 90, selling the SEP 90, and as you can see the way we've done it down here, it'd be nice if we could buy it at a decent price, but it looks like we're paying down here $225. We're in the one call at $225, I'm sorry, $205, and selling the other one at $30. So we're basically paying $1.75 for the spread. Now we're going to plot that just so you can take a look at what it looks like, which I think is a better indication of what this spread will look like periodically. Now the blue line just shows you what is happening to the spread as time, as the stock is moving in price. Okay, so you've got $84, 86, 88, 90, 92, 95. So if the stock were to move in this price range during this 1 or 2 days, you can see there's not a whole lot of risk to the position. Basically, our expense of $1.75 is really not a whole great deal at risk. It's basically vacillating between, right here about $45 out to around $350. The green line, the lime line that you're looking at, this is what is our maximum benefit. Now when you look at this here, okay, what you're looking at is the value of the time spread right here, which is roughly 90.04. All right, and it's showing a P&L of 22.89. That is where we're going to make our most money. The time spread that we're long, closing just roughly above the strike at the expiry of September. So all of a sudden, this position is going to pick up a substantial amount of money, because exactly what I described has happened. Is the near-term call, which in this kind of scenario is going to be the SEP 90, is going to evaporate, even though the stock's going up as we get closer to these remaining 8 days left in the cycle. what will happen is the call will go up and then it'll start getting crushed as we get closer to expiration because it's going to run out of life. Running out of life means it's losing its air and the volatility bubble of premium will come right out of it. The 90 call here, as the stock is going to go up, because it still has 36 and even at expiration 28 days left, is going to continue to increase in price. It's going to increase in its delta because it also has gamma relative to the price of the stock. So as this call goes up and this one goes down, this spread is widening. So now here we're looking at an opportunity where, you know, we're investing $1,750 for a 10 lot, and we got a chance to possibly pick up almost $2,400 on this trade in just a 10 lot position because we don't have a whole lot of risk. Now, you say, well, our maximum risk is $1,750, but that's your maximum risk if you just sit on being along this time spread and watch the stock significantly move way away from the 90 strike, either up or down. Because as you remember by looking at our plot, basically the most important piece of that is that we want this plot, we want this stock to obviously cover right through the 90 strike as long as we're long the October 90 and short the SEP. Now, at expiration, what happens to your position? If you're in the time spread, you decide, well, I'm not selling it yet. Well, let's say the stock closed at $90. If the stock closes at $90, the SEP goes out at 0, and our October 90 call is now sitting probably around $3.50 to $4. Well, now you have a call that's probably got a delta at that point in time, roughly around at the money, so it's going to have a 48 to 50 delta, and it's probably going to sit on $3.50 to $4 of all premium. So you could just sell that call, let the other one expire, and take your profit, the difference of the $4 and the $1.75 that you paid. Or what you could do is you want to maybe put it into another spread.